What is private equity? In this video, I will explain what private equity is, what private equity funds do, and what the risks and benefits of investing in private equity are. My name is Jacqueline van Ende. I'm a co-founder and CEO of Carbon Equity, an investment platform that helps investors make their money matter more by investing in pioneering climate technology companies. So what is private equity? Let's start by understanding the contrast or the difference between public equity and private equity. Public equity refers to companies that are listed on the stock exchange. These companies can be freely traded and anyone can invest in these publicly listed companies. Private equity, on the other hand, refers to companies that are not listed on the stock exchange. These companies are the majority. In the United States, 97% of all companies are private rather than public. So basically all startups and scale-ups that you might want to invest in are private. Private equity is a catch-all term for three distinct types of private equity investments. First, venture capital. Secondly, growth equity. And third, buyouts. Venture capital refers to investing in early stage companies. These companies might have an initial product. Some companies are already selling their product and have an initial customer base. And some companies are already really scaling up. Venture capital investing is typically very hands-on. So a venture capital investor will try to support the growth and success of these companies by providing mentorship, by providing commercial introductions, and offering strategic advice. Venture capital funds are professional investors who pull together a large pool of capital. And with that pool of capital, they will invest in anywhere between 10 to 30 different companies over a time span of 1 to 3 years. Venture capital investing is typically quite high risk. Not all companies in a portfolio of startups will become successful. Often a small number of companies become extremely successful. You call these companies unicorns, companies that are valued over $1 billion. But some companies might also fail and others might make a modest return. So when investing in venture capital, what is absolutely critical is risk diversification by investing in a very strong venture capital fund or in a pool of venture capital funds through a fund of funds. Growth equity is really about investing in scale-up companies. These companies have typically already found product market fit, they have an existing customer base, there no longer is risk in the product itself. And so it's all about scaling up in this phase. Growth equity investors typically try to support these companies by helping them professionalize and really reach the next stage. Often growth equity companies will also support companies through hiring, transitioning from a founder-led team to a professional management team. The risk of investing in growth equity funds is less than of venture capital funds because companies already have proof, they already have revenues, they might even already be profitable. Typically, investing in growth equity funds comes with slightly lower risk and therefore also slightly lower expected financial returns. Buyout refers to a private equity fund buying the majority of the shares, which enables them to have a controlling interest in the company. Typically, when you read in the newspapers about private equity, this refers to buyouts. Buyout funds seek to create value either through restructuring, through operational improvements, or by providing capital to do strategic acquisitions of other companies. Buyout funds are typically less risky yet than venture capital and growth equity, and therefore also expect to deliver lower returns. So we have three forms of private equity: venture capital, investing in early stage companies; growth equity, investing in scale-up companies; and finally, buyout, investing in mature companies. So how does a venture capital or private equity fund work in practice? A fund is managed by professional investors. These are often experts in their field. A fund will start by pooling a large amount of capital. Some funds, small funds, might be anywhere between 10 and 100 million. Mid-sized funds will be between 100 and 700 million, and big funds will raise in the billions of dollars from both private and institutional investors. In the initial years, a fund will seek to add as much value as they can to companies. As discussed before, this might be through mentoring, coaching, hiring the right people, building commercial networks, and strategic advice. After 5 to 8 years, a company will seek to sell their companies. A company might be sold in various ways. Some companies might list on the stock exchange. This is called an initial public offering or an IPO. Other companies might be bought by a strategic buyer. In the case of climate, for example, a lot of these climate technology innovations, such as carbon capture, are bought by large industrial incumbents. A third alternative is that you sell to a competitor or that you do a management buyout. So there are many ways to sell these companies. When a company is sold, funds are distributed back to the investors. So every time a company is sold, you will receive a distribution from a fund. This is called an exit event. So a fund will seek to return anywhere between 2 to 3 or even more times your invested capital over the lifetime of a fund. So why should you consider investing in venture capital and private equity? There are 3 reasons why I think that can be interesting. The first, and not unimportantly, venture capital and private equity funds can deliver high and very attractive financial returns, often higher than in the public markets. One of the reasons for this is that specifically in the case of venture capital, you invest in companies very early whilst they're still a sprout. Imagine that you had invested in a company like Tesla whilst it was still an early stage startup. You would have made a massive return. A second key reason why it is interesting to invest in private equity is because you can have much more impact investing in private markets and in public markets. Typically in the stock markets, you are trading shares between various investors. So when I buy shares of Tesla, I might be buying your shares of Tesla without any money actually going into the company. In private markets, on the contrary, you're directly funding innovation, growth, and scale of these companies by investing capital directly into the company. A third reason why it can be interesting to think about investing in venture capital and private equity is to diversify your portfolio. A well-diversified portfolio would invest a share in the stock market. These are liquid shares that you can redeem at any point in time. You might want to invest in your house or in real estate, which typically has been a rather stable investment. And then for the high returns and also higher risk proportion of your portfolio, you might want to invest in venture capital and private equity. It is important to bear in mind that venture capital and private equity fund investing can also come with significant risks. There are 2 important risks to bear in mind. The first is that high returns also always come with high risk. Especially in the case of venture capital, not all companies will succeed and become Tesla size in the future. In a typical venture capital portfolio, a few companies will be outlier breakout successes and might become unicorns, companies that are valued over $1 billion. Some companies will outright fail, and other companies will make a modest return. The second very important thing to bear in mind when investing in venture capital and private equity is that these funds are typically illiquid. This means that you cannot pull out your money before the end of the fund term. So typically you should only invest in venture capital or private equity funds at money that you can afford to set aside anywhere between 5 to 10 years. So bearing that in mind, it is important to think about capital allocation. Ultra high net worth investors on average invest 20% of their portfolio in private equity. So never, or at least my recommendation would be, do not invest 100% of your portfolio in private equity, but definitely consider it as an important allocation in a well-diversified investment portfolio. In conclusion, venture capital and private equity can play a vital role in driving innovation, growth, and sustainable development. By investing in these funds, you can help scale breakthrough innovations, potentially achieve attractive financial returns, and diversify your investment portfolio. Unfortunately, private equity investing is not for everyone. Typically, there have been very high barriers to participation. You might need a few $1,000,000 to invest in a top fund. You might need a strong network to get in touch with a top fund, or you might need investment expertise to select the right funds. Platforms such as Carbon Equity help you invest in top-tier climate venture capital and private equity funds from low minimums. Should you want to learn more about investing in climate venture capital and private equity, check out carbonequity.com.